One of the strangest developments in modern finance is this. Bad economic news can send markets higher, and good job data will make markets to fall. Weak jobs data? Stocks rally, slowing growth? Markets cheer. Falling consumer confidence? Bullish reaction, good job reports? Stock fall. Why? Because in today's framework, bad news often implies one thing: central bank intervention. Since the 2008 financial crisis, markets have been conditioned to expect liquidity support whenever economic stress appears. Slowing growth increases the probability of rate cuts. Financial instability increases the probability of quantitative easing. Weak data becomes fuel for policy accommodation. And liquidity, not earnings, has been the dominant driver of asset prices. This is the bad news is good news regime. In a normal market environment, economic weakness reduces profits and increases risk. Stocks should fall, bonds should rise. Capital should become cautious. But post-2008, the feedback loop changed. Markets stopped reacting primarily to fundamentals and started reacting to policy expectations. The focus shifted from how strong is the economy to how will the central bank respond. That shift created distortions. Investors began rooting for weakness because weakness meant easier money. Risk assets rallied on disappointing data because liquidity was perceived as more important than growth. This dynamic deepened after every crisis. Minus 2008, QE normalized. 2020, unlimited liquidity. Post-pandemic, rapid balance sheet expansion. The longer this continues, the more markets become dependent on intervention. The danger is obvious. If central banks are no longer able or willing to respond aggressively, the logic breaks. In that environment, bad news becomes simply bad news again, and markets that have been priced on perpetual support may struggle to adjust. Bottom line, bad news is good news is not a sign of healthy markets. It's a sign of markets conditioned to liquidity. And the more dependent markets become on central bank response, the more fragile they are when that response fails to materialize. Subscribe to Hot Breaking News for sharp, real-time analysis of markets, policy shifts, and the forces driving volatility.